Thanks for joining me today. I'm Jordan Borcab from Luzern Risk, and we're all here today to talk about the cost of insurance and why it's a problem and what you can do about it. So let's run through. So quick overview of what we're going to touch on today. We're first going to cover the insurance problem in commercial insurance. So why we've gotten to where we are now, what the problem really is, and how you can fix it. That'll bring us to an introduction of captive insurance, which is an alternative to commercial insurance, and it is something more and more fleets are utilizing to combat the issue of rising premiums. Then we'll walk through if a captive is the right solution for you and give you some pointers on how to determine what the right structure is, and we'll kind of dive into the pros and cons of captive insurance. Actually, by a show of hands, does anyone know what captive insurance is? Oh, good. That's honestly better than I thought. Are any of you guys already in a captive structure? No? Okay. Well, towards the end, we'll kind of review one of our recent success stories for a company that could mirror something close to yours, and how they got out of the ever-increasing commercial insurance cycle. And then we'll walk through what it looks like to get started. So insurance has become a risk. I'm sure you guys are all familiar with that and have seen it on your balance sheet year after year rising. So what do we really mean by that? Well, with rising insurance costs each year, renewals are becoming more and more unpredictable. You don't know how much money you're going to have to spend on the exact same coverage, and in some cases, even less coverage that you were using the year before. So why has this happened, and what is causing these increases? There's really a number of factors at play here, and a few of the most striking facts you can see on the screen, starting with 14 straight years of underwriting loss. This is driven in part because of poor performance. You guys may or may not have experienced a nuclear verdict recently, and these are major hits to your company. We call this a nuclear verdict because usually when cases like this show up in a jury, there are often likely a very large award granted to the defendants regardless of who's really at fault. 36 million, the number on the screen, is the average award for major claims. And this could wipe out an organization. A lot of small and mid-sized fleet operations are hit with these catastrophic claims year after year. And so 36 million is a lot of money, not for just you, but also for the insurance company to cover. Claims are mostly out of your hands, and what makes insurance companies increase the premiums year after year. So if we look over the last 10 years, we'll see that prices have actually risen 50%. Not only is that number quite jarring, but when we look forward, there's really no indication of this getting better anytime soon. So 113% of 2024 is the insurance combined ratio. So for commercial auto liability, this combined ratio is how we measure the profitability of an insurance company. So the total they collect in premiums minus the money they spend on expenses and claims each year. So anything below 100 is good. It means that they're at a profitable margin. For an insurance company, anything over 100 is a loss. So in 2024, commercial auto liability was at a 13% loss. And so what they have to do to combat this 13% loss is charge it back to their insureds. So frankly, the commercial market won't or really can't let you win in this case. From your end, you see the investment that your organization is doing in safety and wonder why your premiums are rising each year. Well, that's because your premiums aren't really based on your own safety record in commercial insurance. Carriers have a price to cover the entire pool. So when there are losses across that pool, everyone's premiums have to go up to cover it. So it's really not based on your own record, even though you might think that if you have a better loss ratio one year that your premiums are going to go down the next. In commercial insurance, you are not awarded that grace. The second reason is that carriers have a profit margin to maintain, as do every other profitable company. So what ends up happening is many safe fleets are subsidizing the more risky operations. So at the end of the day, underwriting profit is ultimately what's paying for another company's profit margin, that other company being an insurance company. However, there is a way out. This is a never-ending cycle in commercial insurance, but over 90% of the Fortune 500 is utilizing another method to make sure that they're not losing year after year in their premiums. And that other option is captive insurance. So a few people in the room know what this is already, but I'm going to give a quick rundown so that we're all up to speed. Captive is a licensed insurance company owned and controlled by you. And really what that means is that you're putting your premium into your own entity instead of the commercial insurance company. Your captive then uses that money to pay out your losses each year. A big question we often get is, what happens if I have a large claim? Well, that's when reinsurance comes into play. So reinsurance backstops anything above your captive's limit, so you won't be exposed to any catastrophic losses. The key difference is what happens when claims are lower than your premium. In the commercial market, that surplus goes directly to your insurance carrier. In a captive, it stays on your balance sheet as a profit. Something many people don't realize is that you can actually form a captive without changing anything about your current insurance policy. One common entry point is a deductible captive, which is an entity that simply holds and reimburses your deductible. It's the same policy, the same coverage. You're just moving your premium into a structure that earns investment income over time. From there, you can expand. You can use the same structure to start underwriting your own risks. Auto liability, workers' compensation, whatever you have a good loss ratio on could be profitable in captives. And your captive is dynamic. It can grow over time as your business takes on new and emerging risks. There are a number of different ways to structure a captive, and we'll touch on a few of the most popular ones in a little bit. So now we understand what captive insurance is. So let's talk about why it's worth building and investing in. Most of you are already absorbing risk. If you have a deductible program, you're already self-insuring to a certain extent. You're self-insuring the first layer of loss. A captive does not change that reality. It just changes who holds the money and who keeps the profit. On the financial side, it allows your insurance spend to become predictable, which shows up in a big way when you do your yearly forecasting and budgeting. It allows your company to become efficient with your capital. Your premium dollars inside your captive earn investment income and receive favorable tax treatment. It's also a way to retain profit. This is probably the most valuable part of a captive insurance program. It's simple. When your losses come in below your premium, it accumulates as owned capital on your balance sheet. Now for the operational benefits, you have more program control. In a typical insurance carrier, you're receiving off-the-shelf policies which have gaps and exclusions baked in because they're designed for the average risk, not tailored to your own needs. A captive lets you design coverage around how you actually operate. It also allows you to have more seamless claims. In a traditional structure, when you report a claim, it goes into what we call a black box. You don't really see or control how your claim is paid out. With a captive, you're able to have full visibility into how those claims are handled and paid out. It also increases incentive alignment for your organization. Once you have leadership buy-in for a captive insurance company and they understand that every dollar saved in your claims comes back to their business, the culture around safety and risk management shifts dramatically. Overall, you're not just solving a cost problem, you're converting what was purely an operating expense into a compounding financial asset. Now let's go over some of the more popular and basic captive structures that we typically recommend for new entrants. There are many different types of captives. The structure you choose comes down to 4 main components. 1, how much you're spending on premium. 2, how much what your loss history looks like. 3, how much risk you want to take on. And 4, how much control you want over your insurance program. One thing to note here is that all of these factors can change over time, and so can your captive. On the left, you'll see a group structure. I like to think of this as you joining a club. The sponsor sets the rules, and qualifying businesses join as members. Everyone's premiums go into a shared pool, and at the end of the year, profits get distributed back to the members based on its performance. This coincides with less upfront buy-in, less risk, and access to profit from an otherwise guaranteed expense. We consider this the entry point to captive insurance. On the right, you'll see a standalone or a single parent captive. This is an entity that you own entirely. So you set the rules, you absorb 100% of the risk and 100% of the profit. So more control, more upside, and essentially more responsibility. Okay. Let's look at how the economics grow over time. So in this graph, we're comparing a group captive and a single parent captive, the 2 structures that we just went over. You can see that initially, it's more expensive to stand up your own structure, which a lot of the times is why organizations go into a group structure. The barrier to entry is essentially lower for those structures. But you don't have the same startup costs, and there aren't the same capital contributions. And although you're sharing the pool with a much smaller group of associations than commercial market, it also comes with some advantages with that smaller pool. So like-minded companies that are well-run, that you can trust, are doing everything they can to drive down the losses, which create a lot of advantages for a group to share. Over time, though, there is a point where this line crosses over the threshold, and that tends to be when your premium gets big enough that the surplus you're generating creates economies of scale to create your own entity. Once that crossover happens, the profit starts to really accelerate when you're in a standalone captive. I like to use the example of a 401k. The longer you're in it, the more it will compound in value. If you start when you're 20, the amount of money you have when you're 60 is astronomically higher than when you were to start investing in it at 40. So the sooner you get into your own structure, the longer you have for those finances to compound, which is why a lot of companies start to look at a standalone structure once they cross over that premium threshold, assuming that they have great loss history. So how do you know if you've outgrown a group model? So if you are already in a captive structure, there's a few questions that you can ask yourself to see if you've hit that threshold already. One, you're one of the strongest performers. If you are, that means that you're likely covering for other people's losses. Even though you're in a group structure, you're kind of cycled back into the same market problem, which is that the risks are pooled and you're paying to cover the losses of others. So if you're a strong performer, it's a signal that you can do well on your own, assuming you have the premium. Two is you're subsidizing the group's structural overhead. It costs money to run a company, and in this case, the group is running an insurance product. So if you have over $1 million in premium, the chances are that you can be more efficient with that cash and running your own operation than groups where the overhead is going to be mystified. You won't know exactly how much is being spent on the things that are necessary for your own operation. Is coverage keeping pace with your needs? You may have emerging risks. You may have invested a lot in technology, and that takes away some risk that you're paying for. So if you're overpaying for insurance, you may have a growing employee base where workers' comp starts to all of a sudden come into the equation. You may have new cyber liabilities because of the technology you're incorporating into your operations. Group captives typically cannot expand the coverage when these emerging risks do pop up on the balance sheet. They're not meant to. So if you need additional coverage, having your own captive gives you that flexibility. Do you feel like your captive is being trapped in the structure? Oftentimes, groups have 3 to 5 year horizons before they start paying out dividends. They want to be ultra safe before they issue back your reward, that there isn't something else coming up that's going to eat into that surplus. That capital is trapped. You can't really do anything about that either. It's sitting on a balance sheet waiting to be released. Well, if you own your own structure, you get to control those rules to a greater extent. Do you have the data visibility or the insights that you would like? A lot of times a group captive, the data is siloed. You don't have access to all of it. However, you have more than you would in a commercial insurance structure. There's reports that you'd like to do, but you're missing out on data and feel like having more data would be important to your operation. Then a standalone captive structure is a great option because it gives you access to that data. And lastly, if you want more control over your program rules, this is everything from the vendors you partner with to where the annual meetings are held. All those can be controlled by you if you own your own insurance program in a standalone structure. So let's walk through one of our use cases. So this is a recent success story for a motor carrier. This client of ours, a national motor carrier running their own operation and operator and dispatch model, which operates nationwide, came to us to help with their commercial auto liability. They weren't always sure about captives. They thought it would be nice to have, but there was no real urgency to get it stood up. At one point, they even told us, well, we'll just wait until next year. But this was before their renewal quote came in. And when they saw that it was a 50% increase, it caused an existential threat to their business. Mind you, they had relatively equal loss history and no material changes over the last year. So nothing that they would consider would warrant a 50% increase. This went from an insurance is an expense to insurance is utterly unaffordable and breaks our business model, making the need for captive insurance urgent. And so we responded. So let's take a look at the results. First of all, they avoided the 50% increase. They stabilized their insurance cost, which might be the most important point. They don't have to lay awake at night wondering what next year's renewal will cost the business. They now have the data to control the losses and in turn control the premium as a result of those losses, allowing more accurate forecasting and stabilizing their cash flow profit retention. Now they're able to design a policy that works for them. They have full transparency into their claims, the loss developments and how they're handled, and also its reserves. They've created a long-term asset, and each year it will grow and respond to their emerging risks. So, is a captive right for your fleet? How do you know if it'll work for you? The truth is, it's honestly not right for everyone. There are some factors that we've already covered today that I want to double back on. You have to have enough premium to qualify you for a captive. For a group captive, we typically benchmark this around $250,000 in premium as the entry point. It can be lower or higher depending on the group, but $250K is a good benchmark to go back to your business with. If you want to explore your own structure to cover your own risk, $1 million is about the point at which the economies of scale make sense. Do you have a safety track record that is dependable? So meaning there's a low frequency of claims that are paid out and it's very predictable year after year. You feel confident that you guys are investing in safety and have a good control on when things are going to be paid out. You can create the right economic structure in a captive to make sure that you're never underwater. So some questions to ask are, do you have good loss controls? Are you committed to driver safety? Do you have the technology? Are you investing in risk management? If you are, then you have the right framework to profit from that investment. Do you have the financial capacity? When forming a captive, you're going to have to commit capital upfront to be stored in the captive in case there is an accident or a big loss. Now, if you have $1 million premium or $1 million policy, it doesn't all necessarily need to go in at once. What you fund into the captive can be different from the premium you own. You owe that captive immediately, but the idea is that you will have to fund the captive the same way. You're paying the premium. Don't forget that this is the same as a commercial insurance in the sense that you're going to be taking money from your balance sheet that would normally go into the insurance premium and you're putting it into a different pocket. And that pocket just happens to be a company that you own. It's important to understand if you have the operational maturity, forming a captive is a process. And so leadership buy-in is very important. Having a culture that supports investing in risk is also important to note. Once you have the captive formed, the incentive is going to be there. So if you want to make sure you're ready and prepared to take advantage of it, you want to make sure that the company is all on the same page. And finally, maybe most importantly, this is not a short-term fix. You don't form a captive to lower your premium this year, although in the case study that we just covered, it happened to be the case, but based on the particulars of that circumstance. But in most cases, it's a long-term strategy. So year 1, year 2 of the captive are meant to be building up reserves. You want a surplus in the captive to be formed as a buffer, a safety net, or a rainy day fund that can support you in the future. So the first few years are spent building those reserves. And then by year 3, 4, 5, we're starting to see enough surplus to start issuing these back to the business in terms of profit. This is a long-term mindset, and you want to think about this as a strategic asset. You're building a company that has advantages of an insurance company, and you can use that in a lot of different ways over the long haul. And so the savings compound over time. So what does implementation look like? If you would like to get started, you would start with first consulting a captive manager. Captives are quite complex, and they can be confusing without the right guidance. Captive managers can help take out that confusion and manage the process for you. Once your captive manager does the initial analysis and thinks the opportunity is viable, you'll proceed to a feasibility study. The feasibility study is where actuaries look at your insurance circumstances and help you decide if a captive makes financial sense for your business. Essentially, they'll say, here's how much we think you will need to pay in premium to be able to cover your losses each year. Using math to determine how your captive insurance company will perform over time. Step 3 is designing the program. This is where you select a group or standalone structure. The program design will cover everything from the details in your policy and the vendors you're using throughout this process. For example, if you wanted to use a TPA or a third-party administrator to manage your claims, all of those details will get sorted out in this stage of the process. We'll then finalize the business plan and submit it to the regulators. Once it is approved by the regulators, you'll move on to management, where your captive continues to evolve over time. But the first step is always most important. Consult a captive manager that is aligned with your risk strategy and helps your business grow over time. So let's sum up what we've covered today. Insurance costs for many cases have gone out of control, and it is one of the top problems for trucking companies and their balance sheet. But there is a way out, and that way out is captive insurance. Captives gives you direct control of your costs. You can manage claims and your own coverage, whether you go in a standalone or a group structure. It all achieves the same goal, which is to get you to keep the profit that's built into how much you're paying for coverage. When you perform well, you'll see this profit growing year after year. This starts with looking at your premium, your safety record, your financial capacity, and making sure you have a long-term mindset. Frankly, fleets that start now are going to be at the greatest advantage. There is a significant competitive advantage to lowering your insurance cost. It gives you more margin to do other things with your business. The process can be complex, so having a captive partner with you from the very beginning to help you manage, plan, and form your captive is essential. Thank you.